Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into CF Industries Holdings, Inc. CF. This is a massive, often invisible company that holds an absolutely essential, almost foundational position in the entire global food system.
Truly foundational.
This is the world's largest producer of ammonia, an unseen giant with a stunning 10.5 million tons of annual capacity.
Which is just a staggering number to even think about.
It really is. And for context, nitrogen, which, comes from their ammonia products, it's not a luxury. It is utterly essential and sustains nearly half of the world's current food production.
So without it, the math on feeding the planet just doesn't work.
It just doesn't work. This is the definition of a foundational business. We've dissected our core investment thesis, which is really going to set up our deep dive today. CF Industries is a structurally advantaged cash machine betting that its low-cost natural gas moat and $500 million annual clean energy contribution will successfully close the 7.5x FCF valuation disconnect by converting a tightening global nitrogen supply into sustainable $3 billion annual Adjusted EBITDA by 2030.
That is a phenomenal statement of intent. I mean, it immediately establishes the magnitude of what CF is attempting to do here.
Right.
They're trying to operate a massive cyclical commodity business while, at the same time, building out a brand new, stable, clean energy business right on top of it.
It's a huge undertaking.
It is. And what's striking right out of the gate is that, well, despite all the volatility that's just inherent in agriculture and energy commodities, their recent financial performance suggests this strategy is already paying dividends. We're talking about the financial results for the first 9 months of 2025.
Absolutely. The 9M 2025 numbers are incredibly robust.
Yeah.
And they clearly demonstrate that their structural and operational advantages are filtering through to the bottom line, even against some pretty significant cost headwinds.
Yeah, that's key.
So let's unpack those highlights starting at the top. Net sales came in at $5.212 billion.
Okay.
Which is an impressive 18% increase compared to the same period in 2024.
18% top-line growth for a company this size that's really moving the needle.
It really is. And when you look at profitability, the operational leverage really starts to shine. Adjusted EBITDA grew even faster, hitting $2.072 billion.
Wow.
That's a 20% jump year over year.
It's important for you, the listener, to understand why this EBITDA growth is so significant. Adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization. It's a measure of operating profitability, stripped of all the capital structure and non-cash expenses.
The pure operational earning power.
Exactly. So a 20% growth rate in a heavy industrial, mature commodity sector like this means they aren't just selling more volume, they're actively increasing their margins.
And that success, it translates directly down to the shareholder level too. Diluted earnings per share, or EPS, for the 9 months ended September 30, 2025, rose sharply.
How sharply?
To $6.39. That's up 31% from $4.86 in the prior period.
31%. Okay, so these aren't small incremental gains.
Not at all.
These are results signaling accelerated financial output and just excellent capital efficiency.
But here's where it gets really, really interesting, because we have to put those profits in the context of the cost environment. This wasn't some easy period for energy consumers. The company faced a massive headwind, a 40% increase in their realized gas cost.
Oof. For an energy-intensive business like theirs, that is a brutal, brutal increase.
It's an existential threat to many of their competitors.
Oh, absolutely. To visualize this, natural gas is measured in MB2, right?
Yeah, right.
Million British thermal units. This is the standard measure of energy content for gas. CF's cost per MMBTU jumped from $2.38 to $3.34 in the first 9 months of 2025.
That's the 40% jump right there.
Exactly. Now, you have to consider that natural gas accounts for 70% of their cash cost of production.
70. It's both the raw material and the fuel.
It's everything. So a 40% hike in your single largest input it typically would destroy your gross margins entirely.
But it didn't. CF successfully defended those margins and then some. They achieved this resilience through remarkable pricing power.
So they just passed the cost on.
They did. Their average selling price per ton increased by 15% across their primary product line.
Okay, so what this signals is fundamental. The global market is so tight, and their products are so absolutely essential to agriculture, that they successfully passed along nearly all of those significantly increased input costs directly to the consumer. And they maintained incredibly healthy margins while doing it.
That's it.
And that ability, that power to absorb a 40% input shock and still grow EBITDA by 20%, that is exactly what separates CF from its higher cost peers.
It's the moat in action.
It is. If you look at the segment data, specifically for granular urea's margin per ton, it jumped 32% year over year in a period of high volatility. This isn't luck.
Yeah.
This is the leverage that their structural cost advantage provides in a tightening market.
And all this operational success, it translates into just staggering cash generation, which is so central to this whole thesis.
Right.
We have to focus on free cash flow, FCF.
Yes, the pure deployable cash. This is the cash generated after all operating expenses and all capital expenditures are accounted for.
This is what's left for shareholders. And their last 12 months, or LTM, free cash flow, as of Q3 2025, it stood at a chunky $1.7 billion.
$1.7 billion. And the quality of that cash flow conversion is just phenomenal.
Oh, so?
Well, their free cash flow to adjusted EBITDA conversion rate is robust at 65%.
That's really high for this industry.
It is. In heavy industrial sectors where your maintenance capital expenditure or CapEx can often be very, very high, converting 2/3 of your reported earnings into pure deployable cash is. It's a hallmark of top-tier capital efficiency and highly disciplined operations.
It shows they aren't just chasing growth projects that consume all the cash.
Exactly. They're generating a huge surplus.
Yet, despite this powerhouse performance, we hit the central tension of the entire investment case, this valuation gap.
The disconnect.
The disconnect. The market, according to management, is entirely missing the story. They point out that the company trades at an, and I'm quoting here, anemic average cash flow multiple of barely 7.5x FCF.
7.5 times, or about 7.9x on a last 12 months average basis.
Right.
Wait, hold on. Why is the market so blind? I mean, surely there must be a genuine rational reason for that low multiple.
You'd think.
If they're generating $1.7 billion in FCF and demonstrating this kind of resilience, what is the source of the market skepticism? Typically, that kind of discount is reserved for businesses with massive execution risk or a history of extreme commodity price volatility that wipes out a decade's worth of profit in a single year.
And that is precisely management's point.
Oh.
The market is treating CF like a generic, highly volatile commodity player whose profits are simply going to vanish in the next down cycle. They're just applying this historical skepticism about agricultural cycle.
So they're pricing in a collapse.
Exactly. But the company views this 7.5x figure, and you have to compare this to industrial peers who trade closer to 27x cash flow and materials peers who are around 30x cash flow.
27 and 30 times. Versus 7.5. That's a massive gap.
It's a chasm, and they see it as a failure by the market to understand their structural moat and, critically, the predictable nature of their new clean energy revenues, which we're going to get into. The CEO was quite firm on this, suggesting that a 7.5x FCF multiple should realistically be the low end of a standard EBITDA multiple for a company of this quality.
So the undervaluation gap is essentially a bet by management against the market's historical pessimism. They're arguing that the global supply tightness and their cost advantage have fundamentally de-risked their future cash flows compared to past cycles.
That's the argument, 100%. And they are acting aggressively on this conviction.
With their cash.
With their cash. They returned approximately $1.3 billion to shareholders in the first 9 months of 2025 alone, mostly through share repurchases.
That shows incredible conviction. They believe their own stock is the best investment they can make.
And this commitment is ongoing. They completed a prior $3 billion repurchase program, and then immediately upon its completion in October 2025, they authorized and started buying under a new, active $2 billion share repurchase program.
So they finished one and just rolled right into another.
Immediately. That new program runs through the end of 2029. They're using their ample cash reserves to aggressively shrink the share count and force that valuation multiple higher.
It's a management team using capital allocation to send a very, very clear message.
It is.
They believe the stock is drastically undervalued, and they are buying back shares from the non-believers at a rapid clip.
Which brings us to the core question. If the financials are this good and management is this confident, What gives them this durability and efficiency?
What's the secret sauce?
Exactly. It all boils down to their core structural advantage, the foundation of their profitability, which we call the natural gas moat.
This is truly the foundation of the CF investment case, and it's so critical to understand the mechanism here. As we mentioned, natural gas accounts for a stunning 70% of the cash cost of production.
7%.
It is the lifeblood of the ammonia business. It serves as both the chemical feedstock, that's where the nitrogen atoms are pulled from, and it's the main fuel source for the massive processing plants.
So when one input dominates 70% of your operating expenses,
Having even a slight cost advantage there is everything.
and their location is the key to unlocking a monumental advantage.
It's all about geography.
It is. Their primary production plants are strategically situated along the U.S. Gulf Coast with deep roots in places like Louisiana.
Right.
This geography grants them access to abundant, low-cost natural gas, primarily extracted from shale fields. And this isn't just a minor discount we're talking about.
No, it creates a massive structural advantage. At certain times of the year, we're talking about a price differential of around $9.50 per MMBtu compared to the high-cost European benchmarks.
$9.50.
It's an arbitrage opportunity that's just baked into their geographic footprint.
Can you put that in context? Like per ton?
Sure. To put that $9.50 differential in perspective, if you're a competitor in Europe buying gas at, say, $12.50 per MMBtu, and CF is buying it at $3.
Right.
And it takes about 30 MMBtu to make 1 ton of ammonia, well, that's a $285 per ton cost advantage that CF has before they even turn on the lights.
$285.
That's what positions CF Industries as one of the lowest cost, most durable producers on the planet.
And this cost differential is amplified by global dynamics, isn't it? The high energy costs faced by European producers, they're just structurally uncompetitive.
Completely. It's forcing many of them to curtail production or shutter plants permanently.
And this cost structure means that high-cost Europe effectively sets the global price floor for ammonia and nitrogen products. It makes Europe the, what do they call it?
The global marginal producer.
Right.
And that is the crucial mechanism. When the global price is set by the highest cost producer, in this case some expensive European plant that is barely making money, it maximizes the profit spread for the lowest cost producers.
Which is CF in the U.S.
Precisely. They benefit from a price set by the competitor who is struggling the most. It's an enviable position to be in.
And it's the reason their margins didn't collapse when their own domestic gas costs rose by 40%.
Exactly. They were still significantly cheaper than the global marginal producer.
But, you know, a cost advantage only takes you so far if you can't execute.
That's true.
And CF layers truly impressive operational agility and efficiency on top of this geologic advantage. This is the management translating that structural edge into maximum profit.
And their performance metrics really confirm this commitment to operational excellence.
They do.
For the first 9 months of 2025, they demonstrated high operational performance with the 97% ammonia utilization rate.
97%.
Running heavy industrial plants flat out at 97% capacity for 3 quarters. That is not trivial.
No, it requires meticulous maintenance planning, minimizing unplanned downtime, and ensuring that whole complex logistics chain runs smoothly.
It reflects a reliability that rivals any global peer.
And their flexibility amplifies that cost advantage exponentially.
You mean switching between products?
Exactly. Nitrogen products come in various forms.
Yeah.
Ammonia is the base, but then you have derivatives like urea and UAN.
Urea is the dry granular fertilizer, and urea ammonium nitrate is the liquid solution.
And these are the two high-margin products farmers primarily buy. CF has the capability to switch production between these two forms in a matter of hours.
Hours, not days or weeks.
Hours.
That is a huge competitive edge in a volatile market. Commodity prices move hourly, so being able to instantly pivot production to capture the highest market margin derivative at any given moment, whether it's urea for dry applications or UAN for liquid injection, that allows for real-time optimization.
So if the margin on urea spikes because of Asian demand,
They pivot. If UAN demand surges in the U.S. for spring planting, they pivot back. That agility turns a structural cost advantage into a margin-maximizing machine.
and beyond the plant walls, their efficiency extends to an exceptional logistical powerhouse and safety culture.
Right, because making it cheap is one thing, getting it to the customer cheap is another.
Exactly. And they possess an unmatched distribution network that is truly diversified. They use the sonic ammonia pipeline, which is critical for moving ammonia through the Gulf Coast.
And barges, right.
Barges, yes. Shipping over 5 million metric tons in 2024 alone. Plus, Class 1 railroads and deep-water port terminals. This whole integrated system ensures low delivered costs and enables a global market reach.
And given the nature of the products, we're talking highly pressurized, highly reactive chemicals.
Yes.
Safety isn't a secondary concern. It's a non-negotiable prerequisite for operational excellence.
And their do-it-right culture, as they call it, is backed by quantifiable results. They've had an impressive 85% reduction in safety incidents since 2011.
85%? That's a huge improvement.
They achieved that safety record through continuous practical innovation. Let's look at a couple of specific anecdotes that really bring this culture to life. For instance, at their Donaldsonville complex, which is one of the world's largest, they developed something called the all-in-one derailleur for railcar safety.
The all-in-one derailleur, what is that?
It's a great, simple example of addressing human factors. Historically, when a rail car is parked, you need two safety measures. A physical derailleur device placed on the track to prevent the car from rolling, and a blue warning flag placed next to the car to signal that work is being done.
Okay, I follow.
The innovation here is just integrating the mandatory blue warning flag directly with the physical derailleur device. It's one piece.
Ah, so you can't do one without the other.
Exactly. It eliminates the potential human error of forgetting to place the flag when the car is stopped. It's a small, tangible solution that dramatically reduces a critical risk of injury during rail yard operations.
I love that. Simple, but effective.
Similarly, at their Wagaman complex, they use the Gas Sentinel, a wireless monitoring system. This thing it's sophisticated. It can detect up to 7 different hazardous gases simultaneously in real time, and it sends immediate alerts to a central dashboard.
Okay, the significance there is twofold. First, it ensures that any leak, no matter how minor, is instantly detected, protecting the immediate environment.
Of course.
Second, and maybe more importantly, it allows for instant notification and response without putting personnel at risk by having to send someone into a potentially dangerous area first just to confirm the hazard.
Right.
These examples show that the culture of efficiency and innovation, from safety protocols to production switching, is just deeply embedded, and it justifies those premium performance metrics.
So we've established a low-cost, highly efficient, cash-generating giant built on a structural moat. But the future growth story isn't just dependent on the traditional agriculture market, which is inherently cyclical.
Which is the market's big fear.
Exactly. The premium part of the investment case hinges on their strategic pivot toward decarbonization as a strategic growth engine.
And this is the second equally crucial pillar of the thesis because it directly addresses the market's skepticism about cyclical volatility. It does that by introducing a high-margin, highly predictable revenue stream.
Right, a new business.
A new business. CF frames decarbonization explicitly as a high-return growth initiative, not just some necessary cost of compliance. Their mission is clear: to provide clean energy to feed and fuel the world sustainably.
Feed and fuel?
Feed and fuel. This is about positioning low-carbon nitrogen products, ammonia, as an energy carrier for global decarbonization. It's moving far beyond just fertilizer.
And this isn't some vague futurism. It has specific, predictable financial returns attached.
Which is what investors want to see.
The returns generated by their carbon capture and sequestration, or CCS, projects, including the verdigris abatement project, are expected to add a consistent, incremental $150 million to $200 million to their free cash flow annually by the end of the decade.
So they're effectively locking in a new layer of high-margin ratable revenue that stabilizes their FCF profile.
That's the plan.
Okay, so let's break down the most immediate and tangible example, the Donaldsonville CCS project.
Yes, this one is already running.
Right. This unit was commissioned in July 2025 following a $200 million capital investment. Its function is absolutely crucial. It captures 2 million metric tons of text CO2 annually.
2 million tons, which is about 10% of their total Scope 1 emissions.
Scope 1 being the carbon they release directly from their own operations.
Exactly. And the economic returns here are phenomenal because they're underpinned by U.S. government policy.
This is the key part.
This project is projected to generate roughly $100 million FCF annually for 12 years via 45Q tax credits.
Okay, so for listeners who aren't familiar with this, the 45Q tax credit is a specific provision in the U.S. tax code that provides a direct dollar-for-dollar credit for every ton of carbon dioxide that is permanently captured and sequestered.
A direct subsidy.
That is the key detail. This isn't a risky market-driven revenue stream. It is a guaranteed government payment, making it essentially a contractually stable source of revenue that's just tied to volume, the 2 MMT they capture.
So you do the math. A $200 million investment yielding $100 million annually for 12 years.
The payback period is under 3 years.
Less than 3 years.
The internal rate of return, the IRR, is well over 20%. That rapid return on a large-scale environmental project fundamentally changes the risk-reward calculation for clean energy investment in this sector.
And looking ahead, the scale of their ambition just grows exponentially with the Blue Point joint venture.
This is the next phase.
This is the next big phase of growth, a massive $3.7 billion greenfield project, meaning they're building it entirely from scratch. And it's developed in partnership with major global energy players, JRA and Mitsui.
CF holds a substantial 40% stake in this venture. They're investing about $550 million for scalable infrastructure that will support the new facility.
And production is set to begin in 2029.
So it's on the horizon.
It is. And when it's complete, this plant will be a game changer. It will be the largest low-carbon ammonia facility in the world, producing 1.4 million metric tons annually.
And the technology they're deploying is critical to their competitive edge in this new clean energy market. They're using advanced autothermal reforming technology, or ATR.
Which is far superior to the traditional process, steam methane reforming, or SMR.
Yes, and you need to understand the difference here. ATR is a highly efficient process specifically designed to achieve a CO2 capture rate of greater than 95%.
95% plus.
That 95% figure is crucial for achieving what's called blue or low carbon certification globally. Traditional SMR plants, even with capture technology bolted on, typically achieve maybe 60 or 65% capture efficiency.
So this is a huge step up.
It is. ATR captures 50% more carbon than a standard SMR plant of a similar size, ensuring that the resulting ammonia product is among the lowest carbon in the world. This commitment to ultra-low emissions is vital for accessing the lucrative new markets and commanding the highest possible premiums.
Which leads us directly to the new markets and green premiums.
The payoff.
The payoff. Low-carbon product differentiation is driving significant new value. Because CF's products are demonstrably cleaner, they already command a current premium of $20 to $25 per ton over conventional high-carbon product.
And that premium is not going to rely solely on goodwill, right?
Not at all.
It's being reinforced by regulatory mechanisms globally, particularly in Europe, which is a major importer of nitrogen. We are talking about the European CBAM.
The Carbon Border Adjustment Mechanism.
Yeah.
So what is CBAM? In the simplest terms, it's a massive tariff mechanism.
The carbon tax on imports.
Exactly. It taxes imports based on the amount of carbon emitted during their production. So for high-carbon nitrogen products entering the EU, that carbon tax will effectively make them significantly more expensive.
And CF's low-carbon products, being exempt or subject to a vastly reduced tax rate, become substantially more competitive.
It virtually guarantees that $20 to $25 per ton premium. It turns a clean manufacturing process into a durable financial advantage.
But the demand drivers for this premium product go far beyond fertilizer and European tariffs.
So much further.
Low-carbon ammonia is increasingly viewed as a fantastic long-term fuel for ships.
Why ships?
Because it burns with zero sulfur and zero carbon emissions. It offers a real solution to decarbonize global shipping, a massive, massive industry.
And it's also a carrier for hydrogen.
Furthermore, yes, it is an efficient, safe, and cost-effective way to transport and store hydrogen, which enables the decarbonization of other heavy industries and power generation globally.
This is a major structural shift.
Huge.
CF is already partnering with giants like the Japanese firms JERA and Mitsui, both of whom are involved in the Blue Point JV, to use this low-carbon ammonia to replace coal in power generation.
So they're moving from being just a fertilizer supplier to a foundational energy transition player.
That dual function, feeding the world and fueling the world, is why management argues their valuation multiple should be so much higher.
And now we layer in the external market factors that are amplifying CF's advantage: growth potential and supply-side tightness.
The tailwinds.
The tailwinds. All those internal efficiencies and strategic moves are landing in a market that is fundamentally supply-constrained, which bodes extremely well for future pricing power.
And that favorable market structure starts with the core imbalance, demand outpacing capacity. Global nitrogen demand is not flatlining. It's projected to increase by a substantial 12-14 MMT by 2029.
which is a robust compound annual growth rate of 1% to 2% that's fueled by population growth, protein demand, and shifting agricultural practices.
So to meet that expected growth, 12 to 14 million metric tons, the world needs significant new supply.
It does. We're talking about at least 7 more world-scale facilities, each one with a capacity of about 1.1 MMT.
And the key is?
They're not currently being built.
Right. The process of permitting, financing, and constructing a new world-scale ammonia plant takes 5 to 8 years and costs billions. And the geopolitical risk is significant.
So this lack of planned new supply makes CF's existing assets and its single massive new project, Blue Point, incredibly valuable.
And this capacity shortfall is being exacerbated by real-time supply constraints driving tightness.
It's getting worse, not better.
First, the high gas costs we discussed in Europe are still a structural problem. This is leading to anticipated 3 to 4 MMT permanent European capacity closures by 2030.
These plants are often older, less efficient, and they cannot survive the long-term energy cost differential.
Right, when they face a massive capital expenditure requirement, like a $50–60 million turnaround.
High gas costs make the decision to permanently shutter the facility a rational business choice, and that capacity is permanently removed from the global balance sheet.
Then you add geopolitical conflict, which is inherently unpredictable but immediately tightens the physical market.
Right.
Ukrainian drone attacks, for instance, removed approximately 1.5 MMT UAN capacity from global seaborne trade.
And that is a massive, sudden chunk of liquid fertilizer supply just taken offline. It contributes immediately to tight market dynamics, especially in regions that rely on Black Sea exports.
So the market has literally had millions of tons of production removed or constrained due to structural energy cost or conflict.
Which strengthens the hands of reliable, low-cost producers like CF.
And we don't have to wait years to see the effects of this scarcity. The immediate market signals confirm the supply crunch is biting hard right now.
What are those signals?
UAN inventories across the U.S. are at a 10-year low.
A 10-year low. Okay, that is the strongest signal available that the market outlook remains constructive well into 2026.
It is.
When inventories are that low, it means any demand shock like strong planting seasons or unexpected buying from massive agricultural markets like India and Brazil will translate almost instantly into significantly higher prices.
And we're seeing robust North American corn planting expectations for the next cycle, which just reinforces this tight outlook.
This tight market dynamic is precisely what allows CF to maintain its robust pricing power, even when its own input costs rise, just like we saw in the 9M 2025 results. They have the cost base to be flexible and the logistical capability to deliver into constrained markets, which just amplifies their leverage.
Now, we should acknowledge the risks that could potentially challenge this tight supply environment.
Yeah.
We've talked about the supply constraints, but we also have to touch on the tariff risks,
Right.
which add operational complexity to these multi-billion-dollar build-outs.
That's a crucial counterpoint. Trade policy shifts are unpredictable. The U.S. Supreme Court is expected to review the imposition of reciprocal tariffs in 2026.
And that could impact the cost of imported materials needed for major capital projects, like the $3.7 billion Blue Point facility.
It could. And while CF has tried to forecast and budget for these uncertainties, using tools like fixed-fee construction contracts, trade policy shifts remain highly unpredictable variables that could balloon capital costs or delay timelines.
So let's wrap this all up with a final verdict and leadership transition. We have a company with a durable geographic cost advantage.
Sure.
Operational excellence that translates cost savings into profits.
Check.
A growing high-margin, stable, clean energy segment, and powerful market tailwinds driven by undersupply.
So the question remains, can they achieve their ambitious targets?
That's the billion-dollar question.
Management certainly believes they can, and the trajectory supports the ambition. CF is targeting $3 billion annual Adjusted EBITDA and $2 billion FCF targets by 2030.
That represents a remarkable 33% FCF growth from current levels.
And crucially, these goals are not based on wishful thinking or projects they haven't even started.
Right, this isn't a pipe dream.
No, they are based on existing identified projects already in motion, such as the full ramp-up of the Blue Point JV and the fully commissioned Donaldsonville CCS unit, whose revenue stream is guaranteed by those 45Q tax credits.
So the thesis argues strongly that this combination of a durable cost advantage, world-class operational execution, and predictable clean energy revenue streams fundamentally justifies management's aggressive stance against that 7.5x FCF valuation.
They're actively buying back shares because they view their own stock as fundamentally undervalued relative to their industrial and materials peers, and, even relative to the guaranteed returns of their own CCS projects.
So if we quickly assess the primary risks, they appear manageable through existing strategies.
Okay, let's run through them.
Natural gas volatility is always present. The spread between U.S. and European gas could narrow.
But CF mitigates this through strong hedging practices, which protect them from seasonal swings and sudden input price spikes over the course of a year.
Right. Then there's the execution risk on the $3.7 billion Blue Point project. That is significant given its scale as a greenfield facility.
It is, but their mitigation strategy is robust. They're leveraging deep experience from previous large expansions and, critically, utilizing fixed-fee modular construction.
And modular construction is a key point here.
It really is. It means they build large parts of the plant off-site in controlled environments and then ship them in, rather than doing all the work on the construction site.
So it reduces risks related to local labor shortages, adverse weather, and schedule overruns.
And it helps avoid the runway labor costs that we've often seen in past multi-billion-dollar industry build-outs.
Finally, let's consider continuity at the top, which is vital when you're executing a multi-billion-dollar strategic pivot. We have a planned CEO transition.
Yes. W. Anthony Will is retiring, effective January 4, 2026, and he'll be succeeded by Christopher D. Bond, who is a 16-year veteran and the current COO.
And this transition appears designed for maximum continuity and execution focus.
It does. Bone wasn't just some internal hire. He was instrumental in establishing the low-carbon strategy, driving the initial CCS investments, and overseeing the formation of the Blue Point JV.
So he was the architect of this strategy.
In many ways, yes. This strongly suggests that the aggressive execution path marrying core commodity strength with clean energy innovation will continue seamlessly.
The departing CEO even emphasized that the entire strategic and operational team remains fully aligned with the goal of closing that persistent valuation gap.
So to synthesize this entire picture, CF Industries operates with a really compelling dual identity. It is, and it always will be, a cost-advantaged giant fundamental to global agriculture, producing the essential component for half the world's food. But simultaneously, it is strategically leading the pivot into low-carbon ammonia, establishing itself as a key, stable, and highly profitable player in the clean energy infrastructure of tomorrow.
The core tension that will define CF's future success, and ultimately its valuation, is its ability to successfully manage two very different economic realities.
Right.
They must continually balance maximizing returns from the highly volatile, spiky agricultural commodity market, which currently provides the massive cash flow, while simultaneously building out the more ratable, predictable, and essential clean energy infrastructure of tomorrow.
And navigating that balance and demonstrating to the market the permanence of those clean energy cash flows, that's what will turn their current investment case into realized triple-digit returns.
Risk defined, portfolio protected.